Okay, I believe we are good to go. So let's start the call. Let's start the call to our new product, which is called Robuxio Equities, which is exchange traded product, which is offering exposure to stocks and traditional finance market in general. Let's do it this way that I will go over the presentation first. Please write down all your questions to the chat because I can get over some of your questions during the presentation. And let's answer all your questions after the end of the presentation. The presentation should take about 45 minutes, so we'll have enough time to go over everything. Also, please keep in mind that I'm representing Robuxio here, but Robuxio right now is a company of 10 plus people. There are more quants, there are software architects, there are other people who were building this product. So it can happen that I won't know all the details. If something like that will happen, we will provide the Q&A after the call. So please write down all the questions in very detailed one. We will get back to all of them. Okay, so what we are solving here as Robuxio on the equity market. Basically, I would say the most important question in investment in general. And this is how we are able to compound, to grow the account with low volatility across different market regimes. Because it is quite simple to make money if the markets are growing, but it is much harder to make money or protect the capital if there is some big bear market or big dump in general. Why systematic exposure to stock? Well, because of course we want to be exposed to stocks. We all know that stock market is the asset class which was building the most wealth in the history. So we want to be exposed to the stock market, of course, but there is one big risk which is significantly growing, especially these days, and it is volatility and prolonged drawdowns, because we almost forgot that in the history there were many 5, 10, 15 years drawdowns, and this is something we are able to solve through systematic exposure, and I will tell you why. Why consider traditional equity exposure in general, and especially these days? There are many reasons. You probably know even better than me because I'm not fundamentally investor, but there are a few very important ones we and me personally are looking at very, very closely. One is the PE ratio of S&P 500, because these days we are getting to 27. It's really in big, big extreme. And on these valuations of the market, if you look to the history and statistically speaking, on these valuations, if you look at 20-year forward annual returns, the average is about 2%. Let's say we are moving anywhere between minus 0.5% and plus 2.5% per year, which is really pretty bad compared to the average annual return on the stock market. So this is one of the biggest risks, I would say, these days, together with concentration risk, because we know how much S&P 500 in general is concentrated. We are getting to 30% share of the technology sector, and we are not very far from where we were on the top of technology bubble in 20 or 2000. So this is really something we have to look at very carefully. And we also have to think about like side question, let's say, because when I'm talking about, okay, let's solve the exposure to stocks in general, let's protect ourselves against some big dumps, bear markets through smart solutions. People sometimes tell me that they will somehow time the top or they will time the bottom, and that we could be in the bubble, but they will somehow be able to get out of that. Honestly, I'm not a big believer in timing the market. Actually, I don't believe in timing the market at all. Why? Because especially in market bubbles, the last run up tends to be very aggressive. We can get through passive exposure to very high returns. But on the other hand, the more aggressive the run up, and right now we are talking statistically really based on research, the stronger the following dump. And this is extremely, extremely important to understand that timing the market, especially in bubbles, is close to, I would say, impossible. What is the answer of traditional finance? Of course, it's diversification, right? So as a smart investor, as a hedge fund, you would want to have some passive equity exposure through some fund. It can be ETF, it can be whatever, basically passive exposure to get the exposure to momentum and trends on stocks, of course. Then to be more diversified, you should have some market neutral type of exposure. What we are talking about here is in general extracting alpha of the market, something which is not dependent on the market movement itself, but it is adding more alphas or edges to your portfolio. Then market theory and diversification is telling you that you could be exposed to some CTA program, aka future trend following, which means that we are buying into trends on different commodities and we are selling to bear markets to other commodities. It's very strong strategy. It is a huge diversifier to passive equity exposure, but it has one huge disadvantage, and these are in general prolonged drawdowns. For example, the whole 10-year period between 2010 and 2020 was called so-called lost period on CTA trend following. These funds didn't make a lot of money. And then you should probably have some tail risk hedging, something which is protecting you against very steep or very big declines on the market. It is usually delivered through different option solutions, usually connected to VIX instruments. It would be smart, and it is smart, but it has one disadvantage. Let's say you put 50% to passive equity fund, 20% to market neutral, 20% to CTA program, and let's say 10% to some tail risk hedging. You are diversified, but your capital is not used efficiently enough because you are spreading the capital, but you cannot reuse the whole pillow of your cash for all the models. And this is actually something we are solving through Robuxio Equities, because we are delivering three main return engines. One is equity beta, another one is systematic alpha, and the third one is tail hedging, because we want to be exposed to the same factors as you would be exposed if you would be broadly diversified across different funds. But this solution has the advantage that you can reuse the same capital across all the factors and all the approaches. We are doing it through 6 complementary portfolio sleeves. One is equity mean reversion. Second is equity momentum. We have tactical allocation sleeve in the portfolio. Then we have real asset trend, aka trend following on commodities. Then we have short-term tactical sleeve, which is basically extracting alpha from the market and is a very short-term one. And then, of course, we do have crisis hedging sleeve. Together, across all these 6 sleeves, we are talking about 50 signal families and 200 leaf strategies. What it means, one signal family is basically one trading idea. For example, some breakout of 200 high on futures or commodities. This could be one signal family, but we want to diversify it also on the single model level. And that's why each model is further diversified through different exits, through different variations of parameters, for example. And that way, the diversification effect is as high as humanly possible. Of course, another form of diversification is, in general, is average holding time. And our average holding time across these 6 sleeves is anywhere between a few hours up to many months. And we will talk a little bit more about it when we will talk about all the single sleeves. This is actually the equity curves of all the single sleeves, and we will talk about every of them right now. So first sleeve, I would say the most important one, because it is also the most robust one, is the equity momentum sleeve. Of course, everyone knows momentum. Momentum is a tendency of asset in general that if an asset is rising, it tends to continue rising. It's oversimplified, but it is what momentum is about. It is basically catching trends. Now, the tradable universe is US ETFs, sector ETFs, S&P 500 stocks, and different large cap stocks. What it does, of course, it is catching trends, it is catching momentum across different indices, sectors, also across different single stocks. The average holding time is anywhere between a few days to a few weeks. And we are talking about 6 signal families, aka 6 trading ideas, and 15 single models. This is the equity of this momentum sleeve itself. What is interesting to see, or as a reminder, that of course this sleeve is doing very well if the market in general is growing. This sleeve tends to make a lot of money. On the other hand, if the market is going sideways, like during 2022, the best output this sleeve can have is basically sideways equity curve. Because of course, if we are trading trends or momentum, we need to have momentum in the market to catch at least some phase of the market. And if there is no momentum, this sleeve cannot make money. But this is solved pretty well through the other sleeve. And equity mean reversion sleeve is the one which is solving aggressive sideways markets in general. Mean reversion, just a quick reminder, basically is the market effect that if something is moving somehow around some mean, then if an asset moves aggressively far from the mean, it tends to, statistically speaking, move back to the mean. Of course, it's oversimplified, but I believe it is good enough illustration. Of course, it works to both sides. Average holding time here is anywhere between 1 to few days, because mean reversion models tend to be quicker. And if the gap is not closed quickly, usually the signal is wrong. The universe is, again, US ETFs, bond ETFs, sector ETFs, and S&P 500 stocks. Now, what is important on this equity curve is to see how this sleeve behaves. Because for this sleeve, to make as much money as possible, we need the elevated volatility. And you can see very well when this sleeve pushed the most. It was during the COVID 2020. It was at the start of 2022 bear market when the volatility was significantly elevated, but it was also at the start of 2025 with the tariff theater. You can see very well how during these periods, this sleeve is pushing the PNL the most, while on the other hand, if there is again very low vol type of market, the market which is moving with very low volatility, this sleeve tends to be flat too. Why? Because in general, a little bit oversimplified, the elevated volatility tends to create many more market mispricings. While if the market is moving just a bit, there are not that many aggressive movements to one or the other side. Another sleeve is tactical allocation. Basically, what's tactical allocation? It is a sleeve which is adding very non-correlated source of returns to the other two sleeves, to momentum and mean reversion sleeve. And what it does is that it trades especially ETFs through different rotation strategies, which are trading based on momentum, relative strength, or based on different volatility regime signals. Again, we are talking about 10 signal families and 35 leaf strategies. So you can already see the idea that each sleeve is already very well diversified. We are definitely not talking about 1, 2, or 3 models in a given sleeve, maybe with one exception, which we'll go over later on. But we are talking about really broad diversification in every given sleeve. This is the equity curve. Again, you can see that it is helping, especially during market downturns, but thanks to the exposure to commodities, to commodity futures ETFs, you can see that it is also making nice money during, for example, 2022 bear market. But you will see very well the diversification effect once I will show you the correlation matrix later on. Just a quick reminder, please, any questions you would have, please write them down to the chat and we will get to all of them after the presentation. Thank you. Now my quite favorite sleeve, because before crypto and before stocks, I used to be trading futures quite a lot. And this sleeve is basically trading CTA type of program in this broad portfolio, in ETI portfolio. It is trading commodity futures trend following. It is trading on gold, oil, and different energy futures ETFs. And average holding time is anywhere between weeks to months, because in general, trend following tends to have much longer holding periods. Now, you can see the exception here. There are only 3 signal families. Why? Because on trend following, actually, there are not that many points, that many different angles you can approach this approach. Why the other way around? In fact, trend following has to be very simple, not to filter out some signals which could be potentially very strong. Because if you filter out some signals, the diversification effect would be quite reduced. Now you can see pretty nicely the return profile of real asset trend, aka trend following, aka your CTA type of program on futures. Usually there are pretty long sideways periods, especially if the market is with is trending with low volatility, if there are no big surprises, if the inflation is low. But on the other hand, whenever the inflation starts growing, the volatility usually kicks in into the futures market, and then you can see how well they are doing. You can see it here, but you can also see it pretty nicely in 2025, because of course these models are also trend following on gold, and gold was big winner of 2025, for example. But on the other hand, even in this period over 2 years, this sleeve was basically flat. It is behavior one has to expect, and that's why to be invested to CTA program only is quite psychologically demanding, because these prolonged periods are just the part of the trend following game. But it's for sure very good to have them as a part of the broad, well-diversified portfolio of many different return streams, which is something we are doing here. Now, the fifth sleeve is all about alpha on the stock market. It is very short-term sleeve. You can see that the average holding time of the positions is anywhere between sub-day, a few hours, up to 1 day. So you can already see that it is very different sleeve to any other ones. Why? Because this sleeve is focused really on harvesting very short-term alpha, some overnight gaps, some short-term mean reversion, or different calendar alphas. Basically, it is connected from many signal families and many leaf strategies together, and that's why it is having very different risk profile compared to, for example, momentum sleeve or even mean reversion sleeve. Why this sleeve is important? Because we don't need big market movements to make money during this sleeve, because remember that the average holding time is few hours to 1 day, and that's why we really don't need long-term trends in the market. The market can be even sideways, there can be even low volatility, and this sleeve can make money. This is something we can see, for example, during the 2022 period, especially here, the volatility basically disappeared from the market, and this sleeve was delivering. It is also a sleeve which can sometimes go sideways just because the alpha is not in the market for some time, and it is again behavior which one has to expect, but it is big diversifier for the overall portfolio. And the last sleeve of all is the tail hedging sleeve, crisis hedging sleeve, however we want to call it. This sleeve consists of 10 signal families, 35 leaf strategies, and what it trades especially are different volatility instruments through, for example, VIX ETFs, but it is also trading on US ETFs, different sector ETFs or country ETFs. We can go long, but we can also short here quite a lot to get the diversification effect and to reduce, for example, the net exposure on the whole portfolio level. So this is really protective sleeve, this is insurance sleeve, and this is also why this is the return profile of this sleeve. As with any insurance, and I'm pretty sure you know it, you are basically paying until you get paid, and then you are paying again until you get paid. And this is exactly how this sleeve is operating. Basically, whenever some big volatility kicks in, this sleeve is making enormous money. But then you have another 2 years even 3 years, actually, if nothing happens on the market, this sleeve will be slowly losing money. You cannot do anything with it, because if you would be somehow timing this tail hedging sleeve, what could happen that you would be out of the market if you need it. So that's why this is actually the risk or the return profile of this sleeve. And there are individual funds which are focused just on this tail hedging. It is interesting. It makes sense for the biggest players, but the biggest disadvantage is that your capital is actually just sitting and bleeding most of the time until you make some money. But again, because we can reuse the same capital on the portfolio level, this sleeve makes a lot of sense. Just a quick overview over the market regimes and the primary return drivers. So, of course, in very strong bull markets, we have momentum sleeve and tactical allocation sleeve. These two ones are the biggest contributors, but on the other hand, during volatile bull markets, also mean reversion sleeve is making quite a lot of money. During sideways markets, the mean reversion sleeve kicks in, and during the sideways market, which is volatile, the mean reversion sleeve is the biggest contributor, while on the other hand, during the sideways choppy markets with low volatility, the short-term tactical sleeve is the one which is contributing the most. Why? Because of the short average holding time, maximum 1 day, and because it is extracting pure alpha. It is not dependent on the market or long-term market movements that much. Then we have bear markets, something we can wait over the next period for sure. We just don't know when. And of course, crisis hedging is the main sleeve which is contributing the most, because we have different volatility models there. We have different models which are short in the market. During inflationary regime, these regimes, historically, it didn't happen in 2021 that much. It happened during 2022. But historically, these regimes, inflationary regimes, were the ones when assets stock market didn't do very well. On the other hand, trend following on commodities was really doing extremely well. For example, in 1980s, CTA programs, trend following programs on commodities, were able to make on average 50% per annum. Huge returns. Probably something we won't see again, who knows? But what's important to know that we are prepared for highly inflationary type of market or period. Then, of course, after some big or steep dump or bear market, we have recovery phase. During the recovery phase, usually there is very strong momentum on the market. So this is the one which is usually caught by momentum, but also by mean reversion type of models. And sudden shock, something like COVID hit, this type of shock is covered by tail hedging sleeve. And on the other hand, it is also covered by our approach to risk management, different portfolio limit, by the way how we are capturing the exposure. Okay, so now to correlation matrix between sleeves. I will send you the presentation. We'll send you also the recording of the presentation during tomorrow, so you can go over all the numbers by yourself. But a few points to mention. One is for sure the correlation between equity momentum and equity mean reversion. It is really huge. How low correlated these two sleeves are. And this is also the reason why this is the backbone of the portfolio in general, momentum sleeve and mean reversion sleeve. Another important point or number is the correlation for CTA trend following. You can see that the correlation is pretty low. And of course, crisis hedging by default is very non-correlated up to negatively correlated to all the other sleeves. And if you look at the correlation of crisis hedging sleeve to SPY, you can see that it is well negatively correlated because this sleeve typically kicks in when S&P or the market starts falling. Now to risk management, because we are talking quite a lot about how we are trading, what are the models about, what is the approach about. But of course, the backbone of trading itself and of investing in general is strict risk management. There are many ways how we are protecting ourselves against different kind of risks. One of the main form is diversification, of course, but we are using a few important points or approaches I want to mention here. One is volatility targeting. Volatility targeting is used on the single asset level, single model level, and on the single sleeve level. What it means is that assets, models, or sleeves which are more volatile tend to be reduced by sizing. Basically, the sizing to the more volatile sleeves or models is in generally reduced. We are also capping the exposure per single stock. We are capping the exposure per single ETF or per each sleeve, because we don't want to have one outlier which is contributing too much, because of course then we would be really concentrating the risk too much into one sleeve, one asset, or one model. So this is something we are capping for sure. And then, of course, we are capping the maximum overall gross or net exposure and also the maximum portfolio leverage. Now, short overview across net exposure. So you can see that the portfolio is moving anywhere between minus 0.3 to 1.2x. And it, of course, depends on the regime we are in. We can talk about it a little bit more on this slide, because, of course, we want to be correlated to the market if the market is going to the upside, right? That's why we have the momentum sleeve, which is catching the trends on the stock market. And during these periods, we are usually highly correlated with the market. And also our beta, aka the sensitivity to the market in general, to the overall market, let's say, to volatility of the market too, is higher. But you can also see how quickly the beta, but also the correlation is moving to both sides. We can be pretty correlated up to 0.8, usually during strong run-ups on the stock market. But whenever the market changes the behavior, aka there is strong drop, for example, or the market is going to sideways movement, the correlation is reduced dramatically because the momentum sleeve is pushed back, and there are other sleeves which are not so correlated to the market itself, and that's why we tend to be less correlated during these periods. Quick overview over market drawdowns. It is showing the 5 deepest drawdowns since the global financial crisis. and the impact to the portfolio. Of course, the deepest drawdown on S&P was during GFC. It was also the deepest drawdown on this portfolio level, but we weren't trading this portfolio during 2008, and there weren't all the instruments, for example, all the proper VIX instruments, so also the tail hedges weren't here properly. So actually, the drawdown would be lower, but to be honest, and not to artificially make the instrument when it wasn't trading, we are showing the drawdown as it would be, because there wouldn't be the instrument to be traded. And the return, just for you to know, is showing where the portfolio ends after or at the bottom of the drawdown. So let's say if we have S&P, it's going from the top to the bottom, and the maximum drawdown is, for example, 40% in this case. Actually, it was a little bit more. The portfolio is behaving this way, that, for example, at the start, we would get to a drawdown, but then some tail hedges, some short models would get in, also mean reversion models, and the portfolio would start making money. And this is actually the secret behind the long-term compounding, to get quickly off the drawdown and to keep the drawdowns as short and as shallow as possible. One specific example, COVID crisis, the market fell down significantly. Of course, during the very first dump, we were also long with the momentum sleeve, but then the momentum sleeve would get out of the market. It wouldn't be trading or just little, but other sleeves would start making money, would start contributing more to the overall portfolio, especially tail hedging, mean reversion, and also real asset trend following, for example. And that's why at the bottom of the S&P 500 drawdown, we would be much higher, and then the compounding effect is adding on top of that. This is actually the magic of this portfolio approach, which is putting together that many non-correlated return streams. Another example is the behavior in bear market and sideways market. During the bear market, again, volatility kicks in. We are making money thanks to different type of tail hedging sleeves and mean reversion sleeves. The same here. But what's also important to mention is that then during 2022, the volatility really disappeared for quite some time. And because we are directional traders, the portfolio is made to be able to provide directional exposure to many movements, to the upside, but also to the downside. If there is no movement or very low movement, the portfolio can go sideways also for quite some time. This is the behavior we can partially reduce by the short-term tactical sleeve, but on the other hand, not everything can be reduced, and not all the time we can make money as directional traders. And right now we are getting to some realistic expectations, aka when we can get easily to drawdowns, even though to shallower ones and shorter ones. So first of all, during very sudden market shocks, where we would be, for example, in some momentum sleeve, we would be really correlated to the market, we would have big fall, and during the initial period of the sudden shock, we would get to a drawdown. You saw it very well during this COVID example, that at the start, we would get simply to the drawdown because we would be exposed to the long sleeve, momentum long sleeve of the portfolio. Then during low volatility drift, of course, something we are talking about in the previous slide, during rapid regime reversals, usually something like trend to the upside for a few weeks, then immediately trend to the long downside for a few weeks. And this type of ranging market, but like longer ranging market, is building some type of drawdowns. And also one thing which is important to mention are strong speculative rallies. During very strong rallies, we can underperform the passive exposure simply because we don't want to be that concentrated, and we want to be protected against the decline, which is always happening. And the stronger, the more aggressive the rally, usually the more aggressive the farther decline or the farther drop. So that's why we are not that concentrated at the last stages, and that's why during the last stages we can slightly underperform. But honestly, this is something we don't care that much about, because this is not what the philosophy of this product is. What we are aiming for, what we are focused on, is the long-term compounding. And the long-term compounding is usually delivered through the combination of low volatility and diversified return streams. Because if the volatility of the account is lower and we are able to contribute to the returns in different periods, then the compounding is really multiplied a lot. It is really making a huge difference. This is the overview of the historical performance after fees. Maybe what is interesting to see is the annual volatility, which is about 12%, 11.5%, compared to S&P 500, which is about 20%. It's average of last 18, 19 years. So you can see that the volatility is actually comparable to your favorite 60-40 stocks bonds portfolio, which is something we are targeting, because we also believe that over the long term, 60-40 portfolio doesn't have to make that much sense as it used to be making during the periods when we were going from very high interest rates, and the interest rates were basically declining slowly, which was pushing the bonds higher. Okay, so this is the overview of the Robuxio portfolio compared to S&P 500 and 60-40. And now shortly what the ETI product is all about. Because actually, initially we were trying to offer this exposure through exchange traded product also for our digital asset portfolios. But we weren't able to find a good partner for it yet. We'll get there. But we realized that we are able to provide this exchange traded exposure through ETI on TradFi, which is very interesting for us, because through ETI, you basically have exchange traded instrument which you can buy and sell with the daily liquidity, not intraday, but with the daily liquidity. It's traded on Börse Stuttgart, and the ETI, what it is actually, the instrument is a so-called AMC, which is certificate, which is tradable quite a lot, especially in Luxembourg and Switzerland, and it is linked to active managed portfolio. We are trading it, you see the NAV, and you get the exposure through your brokerage account, or you can get the exposure through your bank. Basically, anyone who can let you buy through ISIN and who has access to Börse Stuttgart can provide this type of exposure and this type of listing for you. So how it is structured in general, there is an issuer, it is our partner, it's IMAPS ETI AG. This partner is issuer and investment manager. It is issuing this ETI, and it is managing the portfolio under the investment rules, which we signed. Then there are Robuxio Technologies, our company, which is providing the strategy, which is basically the portfolio advisor to some degree, and it creates and maintains the portfolio. Of course, on the back end, there is our Robuxio trading engine, which we are building over 3 years, everything running in the cloud, very advanced solution. This is something we are providing together with all the models and portfolios. Then the asset is segregated. It's separate from the issuer, not to risk anything if the issuer is going down. We are trading on interactive brokers. So on interactive brokers, the assets are held and they are in custody and the trades are executed there. The main cash account, which is connected to Börse Stuttgart, is Bader Bank. And this is the bank which is holding the cash account and which is basically bridging the Börse Stuttgart and our interactive brokers account, or not our, but the investment manager interactive brokers account on which we are trading, and all is settled through Clearstream or Euroclear. So to simplify it, what this product is doing, that through daily NAV exchange traded product, you can get the exposure to our solution just by buying a listing through your brokerage, through your bank, anywhere you can get the ISIN. Yeah, just to sum it up, how to get the access, of course, through interactive brokers. This is the best way how to buy or sell the shares of Robuxio ETI. Or the second biggest partner of IMAPS is UBS. You can also use Deutsche Bank, but you can use any bank or brokerage house. If you would need to help with it, let us know, please, because especially from the start, with some banks, we have to push the ISIN through to accept the ISIN, and then you can easily buy and sell the shares whenever you want through Stuttgart Börse. There are two key dates. One is August 7, when we are closing the subscription window, which we are opening today. So from today on, you can buy already the shares on Stuttgart Börse through interactive brokers or any other brokerage house. We will be collecting the funds until August 7, and on August 10th, we will start trading based on the plan, of course, with full automation. During this period, during the subscription period, it is important to get some allocation because you get the exposure from day one. You are entering actually at the issue price, and you are not facing some initial volatility which can happen during the first trading days on the Stuttgart Börse. Okay, that's all to the presentation. Thank you very much. Let's stay in touch and see you next time.